So I think it's fairly clear that factor-based investing is a at least mildly quantitative approach. So I've never done this in Switzerland, so it might not work. But can we start with a brief statistical exercise? Can everybody stand up? Come on, energy. Okay, thank you very much. Now, those that have invested with a factor-based approach for themselves or for their clients, please sit down. Okay, so that's like actually less than I expected, maybe 18, 20% of the room. Those that are thinking about doing so over the next year, please sit down. Okay, so we're now about half the room. So the people still standing, you're my audience. Welcome, please. So, a couple of different approaches to factor investing. The DB approach is really long-short. We're very much focused in the alternative asset space. We really deliver our factors all in a long-short way. And that's slightly different to other providers, and it fits well with the narrative that we've had so far. We've been very lucky to be very successful in this business. We've got about 11 billion assets now. I would love to say that I did that. It's not true. Most of our success comes from our research group. So we have a very, very strong research group in this area. They publish a lot of academic papers on it. And they're very, very well respected. And they put together, as we've developed this business over the last 5 years, a series of ways that we think about which factors should we include. As in, how do we go from the 300 Paolo talked about to things that actually we think investors should buy? So first of all, they need to be explainable, right? You need to know why they're there, and you need to believe it. Ultimately, investing is a belief. You need to believe it. Second to that, you should believe they're going to persist, right? There should be enough academic evidence to make you, on balance, believe that they're going to be there in the future. Third, they need to be persistently good. Having something which is persistently bad is not much help. Unique. We talked about this already in the sense that you're trying to find things that have different dynamics, right? Find things that offset each other in a portfolio. There's no point adding new stuff if it's just the same as what you already have. And finally, you need to be able to trade them, right? They need to be accessible. It's quite easy to come up with new factors that look fantastic, but once you put in transaction costs and so forth, they don't actually work. So having done that exercise and having been doing this for a while, this is where we end up. We have factors across different asset classes. Here we list 5 asset classes. We also have a few factors now which are actually across and between asset classes. Broadly, and you've seen them in both the previous presentations, you have value, carry, and momentum. And then sort of idiosyncratic stuff that exists within a specific asset class and usually has good reasons for existing within that asset class, but doesn't read very well across into other asset classes. Low beta investing is an example. Now, we can spend a lot of time talking about individual factors, right? And if you're doing a due diligence on this approach, you do need to look at each of these in care, right? You do need to check, do you believe in momentum in the FX markets, right? And you need to go away and do a study and check. Do you believe in carry investing in the credit markets? You need to check. But at the beginning, that isn't usually where our conversations start, right? People need to do that work, but more and more, as this industry grows, people are broadly happy with these concepts across asset classes. I think the key question where you really start is, what are you going to do with this? Right? You've got this toolbox. How are you going to use it? And what's been very interesting for me is over the last 4 or 5 years, actually it's changed how people have been approaching this. So a lot of people start with using this as an overlay to an equity portfolio. One of the most appealing approaches, and there's a lot of consultants who follow this approach, is using this for portfolio completion. And what that means is you go and analyze the factors you have in your portfolio, and then you overlay other factors to balance those. The third is to completely change everything. Throw away your whole strategic asset allocation and completely follow a new risk factor allocation. And then the fourth is using a portfolio of risk factors in the alternative bucket. So we've tried them all, and it's been a fascinating journey. Now, I feel quite strongly that for most investors, a helpful place to start is the alternatives bucket. It's more controlled. It's typically a good first step. the number of people who actually get to strategic overhaul is quite small. There are 2 public examples, and they're both in Denmark. I think one thing I really want to convey is factor investing is academically super easy, right? It's really nothing complicated. You go and read the papers, grammar and French, it's all there, right? This is not complicated investment stuff. What is difficult is organizational change. By far, the biggest problem we come into when we help investors do this is how to change the culture of organizations to approach investing this way. That's the #1 problem. Everyone agrees with the math, everyone agrees with the theory. The practice is, what's the benchmark? How does it fit in my portfolio? What does my board say? What's my style drift? What about other people? What about my peers? Those are the actual problems. So, let's say we're in the alternative bucket. Within that, we tend to see 3 approaches broadly followed. There's traditional alternatives, which is nearly a hedge fund replacement. You're looking for something which has a 20% correlation to equity and maybe an 8 to 10% volatility. What's interesting, in around 40% of the mandates we do, the client sells hedge funds to buy risk factors. It's not every time at all, but in some of the time, it's a definite replacement for hedge funds, and then they're looking for a traditional alternative. The second, and actually interestingly, this has been very popular in Switzerland, is the neutral alternative. So they're looking for a 0% correlation, but lower vol. This is nearly a cash replacement product. And then finally, it's the CTA type replacement. So you're looking for a definite negative correlation, something that's defensive, and a little bit more volatility, a 10% volatility. So how do we actually do that? What we have is 2 scatter plots. The x-axis shows correlation to MSCI World, which is still the dominant risk in most people's portfolios, either directly or indirectly. And the y is sharp. It's just a historic sharp. And all of the dots are different factors. And broadly, and we can spend a lot of time on this, we think there's a relationship where you can have a higher expected return at the cost of higher correlation. It's really hard to find stuff up here. You can find stuff down here, though. So then you come to your client's problem. What are they trying to achieve? And these are 2 actual portfolios. This is a traditional alternative. So they're happy to have a little bit of correlation. You've got a cluster of factors up here. Here is a defensive, much more to the left. Really, factor investing is just a toolkit. Depending on the objective, you pick different factors, you combine them a different way, and that will lead to a different investor outcome. So what have the outcomes been? I'm showing quite a short history. Most factor presentations have like 20 years of backtest, and I thought I'd do something different. This is the last 6 months, and I picked this because we've had a lot of portfolios live over this period. We're now up to 9 diversified portfolios, which are helpful to compare, which are basically 9 different ways that people have invested. The 2 lines at the bottom are the hedge funds. It's been a pretty tough ride for risk assets, right? And as Paolo alluded to, it's actually been a really good period for risk factor investing. Really, really good period. You can see the different objectives, right? So this portfolio, which is up something like 15%, is much more volatile than these portfolios. And that's just because that's what that investor wanted. The other thing that's interesting is you can start to see that risk factor portfolios are correlated to each other, even if you have different investor decisions and even if they pick different factors. And you're starting to see in the industry the concept of a generic risk factor portfolio. So why is this important? We've collectively, as a risk factor industry, been growing this quite successfully. But in reality, the theory about decorrelation to market beta, the theory about good performance through different regimes, we haven't had like a perfect storm to test it. We've literally just been through a very, very difficult period for risk assets. Hedge funds have done badly, active management's had a tough ride over this period, and risk factors has performed very, very well. So previously, I was super bullish this asset class. Now we've just been through this performance experience. Honestly, from the start of the morning, we were talking about where was the Saturday night party after the Friday night party had finished. I genuinely think this is the Saturday night party. Thank you.